Hello, everyone, and thank you for joining us today. My name is Kyle Bell, Knowledge Exchange Coordinator with Farm Credit East. Before we get started, I'd like to offer a few technology tips to keep in mind while viewing today's webinar. All attendees are muted throughout the presentation. Once in a while, it's a good idea to tap your mouse so your screen does not go to sleep during the presentation. There will be a time for question and answers at the end of the presentation. Questions can be text chatted in at any point during the presentation. To send in your question, click on the question mark button on the right side of your screen to expand the question box where you can type in your question. A recording of today's webinar as well as presentation materials will be available at farmcrediteast.com/webinars for after the webinar. Just a quick a mandatory disclaimer that we have. This information is presented in good faith and not to be made for investment, tax, or legal advice and for such purposes. So I will now turn it over to Sadie and Joe, who will give a brief introduction.
Hi, everyone. Welcome. I'm Sadie Constantine, and I'm the conservation planner. I work with NRCS, but also with the Worcester County Conservation District, who we are presenting this webinar in conjunction with Farm Credit today. I'm going to hand it over to Joe, and Joe is going to talk a little bit about the district. I'm new, I just started in November, so Joe's going to talk about the district some more, and he's going to talk about what he does as a supervisor, just briefly.
Thank you, Sadie, and welcome to everybody. Thank you for attending. The Worcester County Conservation District is one of 13 districts in Massachusetts where quasi-governmental agencies that are governed by volunteer boards of supervisors. There's about 3,000 conservation districts across the United States, and they were started to provide local input into government policy as regards to conserving soil and water resources. And that's our main focus. Traditionally, districts have worked very closely with the agricultural sector, and we also provide services to now backyard gardeners, homeowners, municipalities, whoever seeks our advice and assistance. We work closely with NRCS. Our main function is to provide local input into the application of government services to help protect soil and water resources. Our Board of Supervisors come from across the county, and anyone who's a resident of Worcester County is eligible to serve as a supervisor. We serve in 3-year terms, and we actually have openings on our board now, so we're looking for people who might want to get involved. We meet once a month, except for July, and a 3-hour meeting once a month. And we've been doing those remotely lately. We guide the work of the district and our employees, which now includes a field technician or conservation planner, which is Sadie right now. We assist Envirothon teams within the county. We provide scholarships for students going into an environmental or agricultural field. Our big function is every year we have a seedling sale, which is our primary fundraiser for the year, and that started now, and you can go to seedlingsale.org to see what we're offering this year. We're also use quite a lot of volunteers in doing this. We get all the material in one place, and we pack up all the orders together using volunteer help. So we can use assistance with that too. It's been very exciting. We have been able to get grant funding to help us support a conservation planner. We've had people in this position for the past 4 or 5 years. And the main focus is soil health and assisting with NRCS program. So we provide soil testing services and technical assistance to landowners. And Sadie's our point person on that, and she can tell you a little bit more about that if she wants. So, so thank you for coming. I hope you enjoy the webinar. And if you have any questions, just get in touch with us. Thank you.
Great, thank you very much, Joe. So my name is Chris Laughton. I'm the Director of Knowledge Exchange here at Farm Credit East. I'm an agricultural economist by training, but before I joined Farm Credit East, I was a customer. I was a farmer. My family had a greenhouse nursery business in Eastern Mass and in Middlesex County, not Worcester County, but close by. So I've seen kind of both sides of the table, so to speak. I have a bachelor's in horticulture from Cornell and an MBA from UMass Amherst. I will share my screen now, if I can. So let me show my screen.
We can see your screen. Oh, yep, we can see your screen now, Chris.
Okay, thank you very much. So today we're going to talk about farm financial management for beginning and part-time farmers. The concepts that I'm going to speak to are really relevant for, actually any type of farm, whether it's established or just beginning or full or part-time. But the emphasis today is on sort of beginning and smaller enterprises. So I'm going to, give a brief introduction about Farm Credit East and who we are and what we do. We're going to talk about financial statements and how to read and understand them. We're going to cover cash flow budgeting and then financing and credit and working with lenders. And then we'll have some time at the end for questions and answers. And as Kyle mentioned, those questions can be put in at any time. We will answer them at the conclusion of my presentation. So Farm Credit East, we are part of the National Farm Credit System. The Farm Credit System was established by Congress in 1916 to provide credit to rural America. And it's comprised today of about 65 associations that each have defined territories, and they're all organized as farmer-owned cooperatives, including us. So we serve New England, New York, and New Jersey. We serve about 17,000 customers across those 8 states, have more than $9 billion invested in Northeast farming, fishing, and forestry. And those natural resource-based industries are our entire focus. That's all we do. So here's a map of our territory. We have 25 offices throughout the region and a staff of more than 500. Loans and leases for farms are our core business, providing loans for real estate, equipment, operating lines of credit, that sort of thing. But we also have a full suite of financial services, things like tax preparation, payroll service, consulting, and more. So one of the things that's important for really any advice, but particularly if you're just getting started, is kind of define what your metrics for success are. Most people do, get into farming or agriculture because they have a number of what I would call non-financial goals, lifestyle type of farm that they want to do, that sort of thing. And that's fine, but it's important to also consider what the financial goals of the enterprise are as well. Will this business be a primary source of income, or will it be a part-time endeavor? Will off-farm income of yourself or perhaps a spouse or partner be maintained? Those kind of things. And one of the things that I say is that, financial goals do not need to be your primary or your only goal, but they need to be in the mix somewhere, because profitability is really a prerequisite to achieving those other non-financial goals. If you're not at least somewhat profitable, it's going to be hard to maintain your endeavors without, putting additional cash into them, which not a lot of people are in a position to do. So there's 3 main areas of business skills: production, marketing, and financial. And it's important to be competent in all 3 of those, but few people are really great at all 3. So it's important to recognize your limitations and partner or hire the skills that you don't have. So production is your core competency, your ability to produce your product. And if you don't have good production skills, then you're dead in the water. You don't even get started. But that's not enough. You then need marketing skills. You need to sell your product, and then you need financial skills to handle the money coming and going. So to look at that in a different way, we have production management, producing your product or service in quantity and in quality that's going to be appealing to a customer. Your marketing management, determining who's going to buy your product and at a profitable price for you, hopefully. And then financial management, who's going to, how are you going to pay your bills? And managerial accounting, accounting for things like taxes and, making sure that your business is solvent. So to look at an income statement, very abbreviated, here's an example of what we call the 5-line income statement. So it lumps revenues and expenses into broad categories. So here we have gross sales, and this is an example. It's actually an actual farm. Obviously every farm business is different, but I put the dollars and the percentages here because it's kind of typical of what a lot of farms have for results. So gross sales in this case were 134,000. Their cost of goods sold, or their variable costs, and I'll explain what that means in a minute, came to 80,000, or 60% of their revenue. That left them with 40% left over, from which to cover their overhead and their net profit. In this example, the owner's pay, or the owner draw, is included in that overhead cost line. And one of the reasons why I put the dollar amounts there is to show you kind of how quickly the money goes. This is a farm that grossed $134,000 is kind of substantial. But at the end, after they paid all their expenses, they were left with about 14,000, or roughly 10%. And that's kind of typical. And so it shows how how quickly the money goes, and how much you need to gross to have a meaningful profit at the end. So your business may gross more or less than this, and that's fine. It depends on what your goals are. But I just put this up as an example. So cost of goods sold, that second line on the 5-line income statement, sometimes referred to as variable costs. Why is that important, and why do we track it separately? Well, cost of goods sold is any expense that you put directly into your product or service. So things like production labor, could be seeds, fertilizer, feed for animals, that sort of thing. To sort of go back to a greenhouse example, because that's my background. Let's say you're growing hanging baskets. So cost of goods sold would include things like the pot, the basket itself, the growing media, the starter plants, the production labor to pot those up, that sort of thing. Cost of goods sold is important. We track it separately from overhead costs or fixed costs because it behaves differently than fixed costs do. So what are fixed costs? Those are overhead expenses. Those are costs that generally remain the same regardless of variations in your productivity. Or when they change, they tend to change in steps as your business expands. So, in the greenhouse example, these would be costs that are the same whether that greenhouse is empty or full. If I grow 100 hanging baskets, I'm going to have a certain amount of variable costs. If I grow 200 hanging baskets, then those variable costs are probably going to double because they're direct inputs to those products. My overhead costs, in contrast, are probably going to remain about the same. Things like office staff and supplies, my property tax, my depreciation of my equipment, things that are not directly related to production. And again, it behaves differently than cost of goods sold. An example is, if you have a low profit in your business and you determine that you have a cost of goods sold problem, it's hard to grow out of that because increasing your production is going to increase your cost of goods sold proportionally. So if you're going to grow out of it, you need to become more efficient as you grow and reduce those costs of goods sold per unit. On the other hand, if you have an overhead problem, that's something you might be able to grow out of. If your overhead is really high in proportion to your sales, it could be that the scale of your production is just not sufficient to cover that overhead. So increasing your production could be the answer. possibly. One way of determining what overhead costs are of a capital investment, like a piece of equipment or a building or a greenhouse, is what we call the Dirty Five of overhead costs. And that's an acronym that stands for depreciation. That's the cost of the item spread out over its useful life. So let's say you buy a tractor and that tractor costs you $10,000, just to use a round number. And that tractor you think is going to last you 5 years. Even if you buy it and pay cash, you don't expense that full amount in your first year because the thing's going to last 5 years. So you really want to expense that at $2,000 a year for 5 years, getting you to that $10,000 to allocate the cost of that equipment over its useful life. Interest is the cost of financing the item if you have to borrow money to buy it. Repairs are the anticipated maintenance costs of the item. Those tend to increase in the later years of an investment's useful life. Taxes could come into play, perhaps, depending on what asset we're talking about. It could be excise taxes or property taxes. Insurance, if your insurance increases because you built a new structure, that would be another part of that Dirty Five of overhead costs. So you add them all up, and that basically gives you your annual carrying cost of what that investment is. We'll have a case study in a few minutes that will come back to this concept. So going back to the 5-line income statement and just reviewing some of what we talked about, we have our gross sales, which is your revenue, your cost of goods sold, the cost of your inputs into that product or service. That leaves you with gross margin for overhead recovery and profit. Then your overhead costs come into play, and that leaves you with net margin. And your net margin is where you pay your debt principal payments. Interest is a business expense that would probably be an overhead in most cases. But principal payments have to come out of net earnings, have to come out of profits. And also any reinvestment in the business has to come out of profits as well. So getting back to that gross margin, what are some reasons why a gross margin might not be sufficient? So it could be that pricing is too low. You may be just underpricing your product. Could be that your cost of goods sold is too high. Maybe you're not efficient enough to, produce the product at a competitive price. Or it could be something that we call shrink. Shrink can kill you in a perishable industry. And many farming, fishing, and forest products industries are highly perishable, either because the product can go bad or spoil, or because of date, or seasonality. So if you sell Christmas trees, for example, you could be, let's say you're buying them in, you could be buying them in for 10, selling them for 30, you have a great gross margin, everything's going good. But if on December 26th, you have half of them left over, then you probably did it all for nothing. So shrink, product that's grown or made or purchased but not able to be sold due to that lack of demand, poor quality, spoilage, theft, whatever else, that can wipe out your net earnings real fast. Moving on to financial statements, we'll talk about how to create them and how to understand them. So there's 3 main financial statements. The first is a balance sheet, which is a snapshot of a business's financial health, or it could be of a person's financial health. You could have a personal balance sheet as well. An income statement tracks a business's income and expenses over time. And then cash flow statement shows where cash is going in and going out. And it's similar to an income statement, but it's a little bit different in a few ways, and we'll talk about that later. So a balance sheet, in very basic terms, basically you take your assets, everything of value that you own, regardless of whether there's a loan against it. We don't worry about that for now. We just look at, let's say you own a house that's mortgaged. You would put the full value of that house under your assets. Next, you have liabilities. So that would include things like loans, a mortgage, any accounts payable your business has, any accrued expenses, things that you owe money that you haven't paid yet, those are a liability. And so assets minus liabilities equals the net worth of a person or a business. So as an example, here's a very simple sample balance sheet. In this case, we're looking at January 31, end of the month. So this farm has a little over 11,000 in checking account, $1,000 worth of supplies, 4,500 in equipment, and a truck that's worth 10. So that gives them with 27,000 and change in assets. And in the liability side, they have some credit card debt, and they have a loan against that truck for 4,500. So that gives them total liabilities of 5,500. So taking the assets minus those liabilities, that leaves them with a net worth of 21,540. And if you put liabilities and net worth together, it should equal assets. It should balance, in other words, and that's why it's called a balance sheet. Moving on to the income statement. Oh, and just a note, the balance sheet, why do it? Why bother? An important reason for it is, one is it shows you where you stand. As your business grows and becomes more complex, it can sometimes be a little tricky to figure out, what do I really own and what do I owe and that sort of thing. It's also useful if you're going to a lender or seeking credit. It's one of the first things they're going to want to know. So an income statement. An income statement is you take your income, your revenues and sales, subtract your expenses, the things that you spent money on to earn that income, and the result is your net income profit. So a sample income statement, and an income statement is done, it's not a date specific thing like a balance sheet is. It's for a period of time. So in this case, it's a year. And this, let's say it's a year 2021. So this is a vegetable farm. They have 61,000 in CSA sales, a similar amount, a little bit more in farmers market sales. And then they wholesaled some extra fruit that they had that they couldn't really market through their farmers market or their CSA channels. So they sold that to a wholesale outlet, again, to cover that shrink, so they don't lose the fruit. And even if they got less money for it, they're still better than throwing it away. So they got 8,400 for that, and their total revenue is 134. On the expense side, they had 80,000 in cost of goods sold, 10,000 in over. We're splitting overhead and owner draw in this case. So overhead and owner draw comes to 40,000 and change. That leaves them with a net income of about 14,000. So this is a little bit blown up example of that 5-line income statement we looked at earlier. So cash flow budgeting. So cash flow, there's two sort of sides to the coin. A cash flow statement is a historical looking document that talks about where your cash in your business came from and where it went. A cash flow budget is basically the same thing, just forward looking. So if hypothetically, if you have a business and nothing changed or nothing is going to change, you could take a cash flow statement, of the previous year, change the dates on it, and that could be a budget for the coming year. Then you can look at, okay, what's going to change in the coming year, or what do I anticipate changing, and move your budget line items up or down, depending on what you think is going to happen. So, again, why do a cash flow statement or a cash flow budget? Well, it's important to make sure that you remain solvent, that you still have enough money in the checkbook, so to speak, to pay your bills. So here's an example coming up. You'll want to do a cash flow budget. Typically in most businesses, they'll do it month to month for a whole year. And the reason for doing that is because in farming, fishing, or forestry, for that, any of those businesses, your income is likely to change substantially from one month to the next. If you're a vegetable farm, your revenue in January and February is probably going to be very low. You get into March and April, your revenue is still probably pretty low, but if any, but your expenses are going to pick up because you're planting things. You may be starting seedlings in a greenhouse. So you want to track your cash available to make sure you can, make your ends meet, make your payroll, make your expenses, that sort of thing. So here we have in January, we have our income streams, any cost of goods sold we have, leaving the gross margin minus overhead, leaving net profit. So, and then below we have what we started with for cash, what the change in cash was for the month, and then what our ending cash was. And the ending cash becomes the starting cash for the next month. And you just go like that from month to month, map out the year, and then you can see, do you have any shortfalls? Are there places where your cash is really tight or even negative? And maybe you need to put in some savings or have a line of credit or that sort of thing. But it's a lot better to anticipate a cash shortfall than to find yourself in one accidentally because you didn't plan. So if we blow this up to a whole year, I know this is really small and you might not be able to read it all, but this just shows basically that same thing that we looked at before for 12 months. And the income and expenses are in green and the cash flow is in yellow. And then if you blow that up even more and you get all of your line items, you can see that this becomes, a rather complex spreadsheet, but it's a good way to track, where all your expenses are, where your money's coming from, where it's going to. So to drill into this a little bit, in the top section, this is looking at the first 5 months of a year. We have farm income. So in this case, this is a CSA vegetable farm, community supported agriculture. They're selling farm shares ahead of time. So they're going to have some revenue in January, February, and March because that's when they're really marketing their 2022 CSA shares. So that's heavy in January, February, March. It trickles off in April and May. And then by June, late June, they're going to start selling, fulfilling some of those CSA shares that they sold. Here you can see January, February, we don't really have much in the way of costs, but they start to pick up in April and May. So that shows our income, our costs, and our gross margin for each month. If we look at the bottom half of this chart, then we get to overhead, and then we can see below here this other sources or uses of cash. And that's kind of important because you can have events that are not really an expense for your business or not an immediate expense, but they affect your cash. So in this case, we bought a tractor for $5,000. We traded one in that was worth $500, and we borrowed the money to do it. So here we had an equipment purchase that took out $5,000 from the checkbook. We got $500 for our old tractor that we sold. So that put $500 back in, and our net that we needed in terms of money was $4,500, and we got a loan for that. So here we can see, so that was basically revenue, cash neutral, but it's important to kind of recognize it. We had 6540 in cash flow to the positive that came in because of our revenue and our expenses. So we began the month with 5,000 in the checkbook or in the savings account. We added 6540 from operations, and we ended with 11,540. So that 11,540 becomes the starting amount for the next month, and it goes on. And you can see here that in like March, April, and May, our cash flow is negative because we have more expenses than revenue. And our checkbook balance goes all the way down to 3,000 by the end of May. So it's important to consider that and be sort of prepared for it and think about, am I going to need supplemental cash to keep my business solvent? That doesn't mean that you are losing money because you're going to see revenue come in later in the month. It means you have a monthly cash flow issue. So this is available as a spreadsheet, as a pre-made spreadsheet if you would like. Here's the URL to access it. And we will put a link to this or a copy of the spreadsheet at farmcrediteast.com/webinars as well. So moving on to a case study on capital investment. How do you decide whether it makes sense to make a substantial purchase for your farm? Well, a lot of businesses they might think about it, they might pencil things out a little bit, but a lot of times businesses make even, farm businesses will make even substantial cash capital purchase decisions, sort of, on a hunch and then hope that it pays off. And that works for a lot of farms, but it doesn't work for others sometimes. And it's much better to plan ahead and prepare for profit, if you will. So the first step really in any capital investment should be, how much profit am I going to need to generate from this investment? So in this case, we have a turkey farm. They're growing and selling turkeys. And right now, in this example, they're sending them off to an outside facility to be slaughtered. And then they come back and then they sell them on the farm and through a pre-ordering in a farmer's market. So in this case, they think it might be beneficial to bring that slaughter in-house and build a slaughter facility for themselves. And they've put together a budget. They've got some estimates. They figure it's going to cost. I'm just using this to keep the numbers easy. They figure it's going to cost $200,000 to build a facility, a structure that's going to be able to process 2,400 birds annually. So how much profit do they need to generate from this? Well, they're going to borrow the money. So we need, if it's a 10-year note, we're going to need $20,000 a year just to cover that investment, that borrow money. Then we've decided that the owner, right now it's a part-time venture. The owner is going to need to become more involved and spend more time on it if they do the slaughtering themselves. So the owner draw is going to need to increase by $20,000 to make this worthwhile. So we need to add $40,000 in total additional profit beyond what the farm may be earning today. So here we look at what's the capital cost of this structure, $200,000, and then we looked at the loan. But it's going to cost money to maintain and operate this. So where is that going to come from? So here we come to the dirty five that we talked about earlier. So depreciation of the equipment that's in the building, the interest on the loan, as we showed before, we just looked at principal payments. $20,000 a year for 10 years gives you $200, but we're going to have interest to account for. What are the repairs? Anything with moving parts will break eventually. Is this going to affect property taxes because I made an improvement to my property? And then do I have to insure this building? So here we figure the dirty five of this $200,000 investment is going to total up to $25,000. Then I'm going to have utilities, et cetera, of another 15. So my overhead to operate this structure is 40,000. We determined the additional profit I need to earn on this investment, which coincidentally is the same amount. It's an additional 40,000. So in additional gross margin, I need 80,000. Otherwise, it's not worth making this investment, and I should just keep sending my birds out for slaughter elsewhere. So here's the additional gross margin I need. So how do I determine my gross margin? Well, my retail price is going to be $4 a pound. And I'm a marketer, so I'm going to say $3.99 a pound. That I've determined that that's roughly double what a supermarket might charge, but I think I can get it because my turkeys are better. They're local. They're free range. They're happy. They have all these positive attributes. I have a good story to tell, so I'm going to get more money for them. I think I can get double what a supermarket might charge. What are my costs of goods sold? Well, I have feed, bedding, poults, the baby turkeys, supplies, labor. So my cost of goods sold come to $2 a pound. That leaves me with a 50% gross margin. For every pound I sell for $4, $2 of that is going to go directly to the input costs. So retail price 4 less cost of goods sold 2, that gives me a gross margin of $2 or 50% gross margin. So backing into that sale requirement of what I need to generate an additional gross margin, $80,000. So if I divide that by gross margin, that means I need to sell 160,000 in revenue to achieve that 80,000 in gross revenue, and gross margin. So if my turkeys weigh 20 pounds, that means I need to sell 2,000 turkeys to cover my annual overhead costs and generate the desired profit. Things look like they pencil out. That's okay. My capacity of my facility I'm going to build has a capacity of 2,500, so I have some room for growth. Everything looks good. However, I do some research and I find out that there are other local farms that are selling fresh turkeys, locally grown, for free range for $3.20 a pound. So that puts a problem with my strategy, because I may not be able to get that $3.99 if the farmer down the street is charging $3.20. You know, I can compete against the supermarket, but if I don't have a value add against this neighbor, then I'm gonna maybe struggle to get a lot more than what he's getting. So what if I match his price? What's that gonna do? Well, if I charge $3.20 a pound, my cost of goods sold aren't gonna change, because, you know, my feed's gonna cost the same, my labor's gonna cost us, you know, everything's gonna be the same. So that 80 cents difference is gonna come right out of my gross margin. That's gonna reduce my gross margin to 120 or 38%. So what does this mean for my plans? Well, I needed 80,000 in gross margin. Now my gross margin is only 38%. So that means I got to get 210,000 and change in target sales if I'm going to still meet my goals. And what that means, you know, in terms of birds, is I need basically 3,300 turkeys to cover my overhead costs that I determine. So what's the problem with this? Well, there's a few. One question is, can I sell 3,300 turkeys? Is the market going to bear that? You know, is the market there for that? I thought I could sell 2,000 without a problem, but 3,300 is a third more almost, or roughly a little bit more actually. Do I think I have the customer base for that? And then another problem that I have is that my facility I was going to build could have had a throughput of 2,500 birds, and now I would need to sell, you know, exceed the capacity of that. So basically, what this means is this scenario remains unresolved. I have to go back to my business plan. There were two scenarios. Scenario one worked, 2,000 birds at $4 a pound and a gross margin of 50%. Scenario two doesn't work. So what do I got to do? I got to either figure out a way to get closer to that desired retail price, or I got to somehow increase my gross margin, either become more efficient in growing the turkeys, or I need to go back and look at that overhead and profit I wanted and figure out, you know, do I really need 80,000? You know, can I build the facility cheaper? Can I reduce my owner draw? You know, what do I need to do to get that down? So this is something where I need to kind of go back to the drawing board, so to speak. But the point in all this exercise is, isn't it better to do this on paper ahead of time than just jump into it and then find out midstream, so to speak, that I have a big problem? So it's a lot, you know, there's a saying, it's a lot cheaper to make mistakes on paper. So we'll leave that unresolved as an example. Moving on to financing a business. So one of the things that often comes up when I talk to farmers is they ask about grants. Grants are great. You know, don't get me wrong, but they often come with strings attached. A grant maker is usually seeking to promote some type of public good. They're not just looking to shovel cash out the door. They're usually looking to achieve something, such as education, energy efficiency, research, conservation, business development, you know, goals that sort of benefit society in some way. They're not necessarily out there just to benefit you as the grant recipient. So, and they may have significant outcome or reporting requirements. So it's important to make sure that those requirements and those grant outcomes align with the goals of your business. If the grant outcomes or reporting is incompatible with your business, then maybe that's a grant that doesn't make sense for you. Most grants are for established businesses. A common area is, say, energy efficiency. Like if you have a barn or a greenhouse and you're going to do more energy efficient lighting, you may be able to get a grant from USDA or from a utility to help cover part of the cost of that improvement in lighting. That's just one scenario. Occasionally there are grants for startups. They're more rare, but they do sometimes come up. So to research grants is worth looking into, certainly. There's a URL at the bottom there, farmcredits.com/reports. You can access a report we've done on basically all the grants we could find that are out there. It's also worth checking into your State Department of Agriculture, in this case MDAR for Massachusetts, and seeing what might be available from them. There's two types of outside money that comes into farms. One is equity financing or investment, and the other is debt financing, and they're a little bit different. Equity financing typically comes with ownership. So that's if you put money into it yourself, or you take on a business partner that where they get a share of the ownership of the business. This is a high risk of failure in that if the business goes south, then you typically will lose your investment. Debt financing, on the other hand, is what a typical bank would provide. This does not usually dilute your ownership. The cost is limited to the interest, but you do have to pay it back. It's often based on collateral, and usually they want to see a track record of positive earnings. It can be hard to get debt financing for a startup business because you're record and you may not have collateral, perhaps. And this is kind of where banks live. Seeing that as an issue, that it can be tough to get debt financing for a startup, Farm Credit East created a program about 17 years ago called Farm Start. And this is designed for beginning farmers who may not meet traditional lending criteria. They may not have the collateral, they may not have a down payment, they might not have a track record of positive earnings. And so it invests up to $75,000 in capital for new and beginning, or early stage, 0 to 3 years perhaps, agricultural enterprises. We've done more than 300 of them since we started. Starters have up to 5 years to pay back the funds or roll it into conventional financing. The funds do have to be paid back, and there is interest charged, but it's prime plus 2, which is currently 5 1/4. So it's certainly a lot less than other options. Like we saw a lot of entrepreneurs putting things like this on credit cards, which are much higher interest, obviously. It's not designed to buy real estate. It's designed to be operating funds. So it could be combined with other financing. You could get a mortgage for a piece of property, and that's great, but that gets you land. You still need to maybe hire someone, buy a tractor, what have you. So this is designed to be that operating capital piece. But beyond that, there's a lot of options available. There's Farm Credit East, of course, where I'm employed, but there's also the USDA Farm Service Agency. The seller can be an important source of financing for a purchase. There's commercial banks, of course, and then there's other nonprofits or quasi-public entities like community development corporations or economic development agencies that may loan money to startup businesses. Credit scores. I'll talk a little bit about that real quick because they're important if you're going to approach a lender to borrow money. They're going to look at your credit score as one of the primary methods of evaluating your application. So the range is 300 to 850, just like the SAT, you get 300 points for showing up. The higher the score, the more willing lenders will be to loan you money and loan you more money, and the lower the rate they'll typically charge. Interest rates are based on risk. Below 650 is generally considered subprime credit, and they're going to ask for a much higher interest rate from you. There's 5 main factors that affect your score. Number 1 is your history with credit, the number of accounts you have that you paid on time, the number that you're delinquent on, if any, and for how much you owe relative to your income, and relative to the amount of credit available to you. So that's a little bit not necessarily intuitive, but what it means is they call it the credit utilization ratio. So lenders like to see unused credit on your credit report. They like to see that you have a lot of credit available to you and that you're not using a high percentage of it. And what that does is that, that provides them sort of confidence that others are willing to extend credit to you as well and that you're using it sparingly. So unused credit helps your score. The length of your credit history matters, the longer the better. New credit inquiries can affect your score. If you're shopping around for loans and you apply for a bunch of loans, each new application for credit that goes through will lower your score a little bit. And then 5 doesn't matter a lot, but it's, the types of accounts on your report matter somewhat. So how to affect your credit score? Well, first of all, be wary of companies that promise to fix your score. There are companies that advertise on late night television. There's no shortcuts. If you have a lack of credit, it's a good idea to apply for a credit card or a small loan and make payments on time to build your credit. If you have impaired credit, do the best you can to make payments on time, pay down debt if you can, avoid maxing out cards, spread the debt around among several cards if you can do it rather than maxing out one or two. If your credit's okay, but you need a bump to make your application more competitive, ask credit cards for a limit increase even if you don't need it. That'll lower your usage ratio, which helps you. And then obviously you want to correct any errors and dispute things if they're inaccurate. So how do lenders make decisions? Well, there's what we call the 5 C's of credit. Character, capacity, collateral, capital, and conditions, and I'll run through those. Character, obviously your character is much more than your credit score. I don't want to infer that, but from a lender's perspective, your credit score sort of demonstrates how you've handled credit in the past. So that's a big consideration. You should know what's on your report and be able to share and explain any problems that exist. Your capacity to repay the loan. What are your earnings today and what will they be after the investment? And here your history is important. Lenders are typically going to want to see your last 2 or 3 years of tax returns to see what your track record of earnings is and whether or not you get cash flow loan payments. Collateral. This is the lender's fallback position. This could be real estate or it could be other assets. That's an important consideration because it helps the lender manage risk. Capital. Do you have skin in the game? You know, what's your net worth? Ideally, it should be 60% plus. If your net worth is below 50%, that means your creditors own more of your stuff than you do. And we occasionally even see people that come in that have negative net worth. You know, if they're a recent college graduate that have a lot of student loans and don't have a lot of assets, they may have negative net worth. That can be tough to work with. Conditions. This is the terms of the deal. They should match the life of the asset financed. So for real estate, that could be up to 30 years. But for machinery and equipment, you want a shorter term that's going to match. You know, you don't want to be making payments on a car that you've junked already. You know, livestock and inventory would be shorter term. So lenders are going to look at who are we lending to, what is their ability to repay, what is their financial position and net worth, and then what is the risk of the loan, and what are the conditions of the terms. So a few turnoffs just to wrap up that turn off lenders. If you're working with a lender, you want to avoid some of these things if you can. Poor records are probably the biggest one. Sometimes we'll ask a farmer, you know, well, do you have business records? And they'll say, oh, yeah, I have a whole shoebox full of receipts. Well, that's not really the ideal record keeping system. You want to have good and accurate and up-to-date records. High existing debt and low credit scores can be tough. Relying overly on collateral without enough earnings to cash flow payments. Unrealistic expectations, you know, an investment that's going to, you know, grow your business by 300%. Well, you know, what if you build it and they don't come? What if the sale, you know, a buyer goes away or things don't materialize? And then lack of cooperation and commitment in tough times. Almost every business has a rough patch at some point or another. It's important to stick with it and maintain those lines of communication with your lender when things are tough, because the more you communicate with them, the more they're able to work with you and help you out. So that was an awful lot. I went through it real fast, but the slides will be posted on the farmcredits.com/webinars page, so you can access them there. There's my email if you have questions and want to follow up with me on anything. And we will also entertain any questions that have come in now. So I will turn it back over to Kyle if you want to see if there's any questions that we've got, and we can address those.
I think the big question that came in was if the slides will be posted, and you just answered that. So if anybody does have any questions, feel free to click on the little question button, type in your question, and we will be happy to answer any.
Yeah, I apologize for running through so quickly everything. I wanted to get to it and allow time for discussion afterwards. But we'll give a couple minutes for questions to come in. But I will revisit a couple of things.
Chris, I know you touched on grants. Can you touch on, I know Farm Credit East does a grants and initiatives report.
Yeah,
can you
that's
touch
a
on
good
that?
one. Yeah, farmcrediteast.com/reports is where we archive all of our reports that we produce. In there, I think it's like the second or third report listed is our grants report, which we update periodically. And these are grants not necessarily from us, but we had someone go through and spend a fair amount of time, because just finding out about these can be a really time-consuming thing. So we looked at, what is available out there, and we categorized them by type of grant, whether it's energy efficiency, business development, environmental, what have you, and then also listed them by state for ones that are state specific. So that can be a good resource and worth looking into. We can't present that it's completely comprehensive. There may be some we've missed out there, and also things change from time, over time. So it's also worth checking out USDA Farm Service Agency and MDAR, State Department of Agriculture, to see if there's anything new that's come out.
Looks like we had some questions come in, Chris. Can you discuss some common pitfalls for a new farmer when dealing with credit issues besides poor record keeping?
Sure. So record keeping is a big one. Another one is making sure that your business plan, that what you plan to do, is lucrative enough to pay back any money that you're borrowing. Sometimes people get into, a startup farm because they want a certain lifestyle, or they want a homestead, or they want to have a small farm and sell some stuff at farmers markets and that kind of thing. As I showed in that 5-line income statement, oftentimes, your bottom line is a lot smaller than your top line, because it's going to cost you money to grow that stuff and produce those products. So you want to make sure that your bottom line is going to be enough to pay back whatever money you're going to borrow.
Okay. So kind of think on the insurance side of things. When requesting a loan, does banks or Farm Credit in particular request a particular level of insurance protection, owned or purchased by the applicant, say for if they have a livestock business, having livestock insurance, or one of the other kind of crop insurance type programs?
Yep. So lending, in a nutshell, really comes down to managing risk. We're putting money out the door. We're giving someone, say, $100,000, and that's a real leap of faith. Are we ever going to see that $100,000 again? So we want to manage and mitigate the risk of that, of non-payment. So lenders, and it really comes down to case by case, but lenders may require insurance on something, particularly if it's an asset that's collateralizing a loan. So if you're buying, say, a tractor, let's say you buy a $20,000 tractor and you're taking out a loan to finance, 80% of that, the lender may require you to have insurance on that tractor, so that if it catches on fire, is stolen, whatever, the lender is not exposed, and has nothing to fall back on, for security. So they may require that asset to have insurance on it. We typically do not require any kind of crop insurance. It's certainly encouraged, but I don't know if there's any cases where we've actually required it. But we definitely recommend at least looking into it, because it can be an important risk management strategy for your business. We may require something like liability insurance for a business, just to make sure that you're not going to have a person slip and fall and sue your business out from under you. So insurance requirements do come into play sometimes, and they will vary depending on the circumstances.
Okay. Just a quick question that I can answer came in about for my Farm Credit East programs and assistance for minority and women-owned businesses. That would fall under our YBS program, which is our Young Beginning and Small Part-Time Farmer programs. More information can be found on our website in regards to that, because that is quite the broad topic. So another quick question, Chris, for you that came in, I think, from a number of different people. Two questions, I think, in one. Why should a non-commercial farmer be worried about record keeping? And then what online programs, besides apart from QuickBooks, is a good recommendation for farmers?
Sure. So there's a couple of parts to that. If you're when you say non-commercial farmer, it depends on how you define that. If your primary source of income is an off-farm job and you want to have, grow some vegetables on the side and sell at a farmer's market on weekends, or have a hay field that, you just have someone cut and sell the hay, then maybe you don't need records if you're not relying on that farm for income and you're not going to borrow against your farm enterprise. Then kind of do what you want, so to speak. No one's going to force you or tell you to have records. But as that farm becomes more important to you in terms of a portion of your income, the more important record keeping becomes. And if you're going to, you're going to need a certain amount of record keeping to pay taxes on any income that you have. And if you're going to borrow money, then a lender is going to want to see some records as well. So that's where those become necessary. So when you say non-commercial, if you're not relying on it for income, I would say that they're less important. But once it starts becoming a substantial portion of your income, you really should be trying to keep good records. For record keeping, QuickBooks has sort of become the de facto standard for small businesses of all types. And we see a lot of small farms using that, and that works reasonably well for most farms. There's another software company out there called Red Wing Software that has really good agricultural record keeping and financial software also in there. You can find them online if you search Red Wing. Those are kind of, I guess, the two go-to that I would, suggest. And some you can even do in Excel too.
Yep, and that just answered one of the other questions. Someone just recommendations for which software, and they kind of quoted all the ones that you just said. I think kind of a more technical question for like a balance sheet or profit and loss statement. How do you categorize the utility expenses, like say greenhouse heating, lighting, such as a line item? Would you put that in utilities or something else?
Yeah, so you would put your utilities, I would call it utilities and put it there. Whether you consider it a fixed or a variable expense sort of depends. And I would say for a greenhouse, you might even want to consider that a variable or a cost of goods sold expense, because the more you use that greenhouse for growing crops, the more heat you're going to put into it, and or lighting, and the more your utilities are going to cost you. If you say you have utilities for a cow barn that is, where you're going to have to do the same amount of utility usage, whether it's empty or full, then it's maybe a fixed expense. But the important thing is that it's in your expenses somewhere as a utilities line item. And whether it's variable or fixed expense would depend a little bit on your operation.
Great. So I think the final question we will end with, I think, is a good one. Chris, what is a piece of advice for a new farmer just starting out or start looking to get into agriculture would be a piece of advice in a few words?
So, boy, there's a few things. I ran a farm before I joined Farm Credit East, and I learned mainly by making mistakes, unfortunately. And I learned a lot of lessons, and it's hard to put those into a few words, but I would say that an important thing is to make cash flow budgets. That's really important, to make them realistic, and make sure you're going to be able to make ends meet, so to speak. Make sure you're going to have enough cash on hand to pay your bills. And it's good to forecast that in advance if you're going to have any shortfalls, so you don't get stuck or caught. And if you foresee a shortfall, then you maybe need to look at a line of credit or some additional money resource that's going to help you get through that. Having a business plan is important. Doesn't need to be a million pages. It can be real basic, but what you plan to do, how you're going to make money doing it. Again, your money doesn't need to be the only goal of your operation, but it's got to be in there somewhere if you want to remain, financially sustainable.
Great. So I think that kind of wraps up all the questions that came in, Chris. So as we said at the beginning of the presentation, everybody, the recording as well as Chris's slides will be available at www.farmcrediteast.com/webinars. Usually we will have it try to be posted in the next couple of days. Definitely by Monday morning, we should have something up for everybody to view. With that, I think we will sign off for the afternoon, and everybody enjoy a very beautiful day outside in New England.
Stay warm.